Tosha Global Analytics. Please like and subscribe. Greetings, salutations, and howdy to you all. I'm KT with Tosha Global Analytics. As always, Tosha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. So it's that time of the quarter where new data always starts coming available, and we got a couple of great sources of data for office properties that came in. So I'm going to do an office, kind of a broad sector update today. And after all, it is one of those topics that really resonated most resoundingly was my office property case study and the capital stack expansion video that followed. The latter covered how the private equity partners might navigate a workout scenario in the midst of falling prices and existing equity partners abandoning their investment when the market shifted so dramatically. So now in August 2023, we are seeing issues domestically and globally that are showcasing that the problem is backbuilding in China, in the EU, and also in the U.S. For some reason, the U.S. press, including the economic forecasting and business press, they're largely on board with this narrative of no recession, no real estate crisis. Or if they mention the real estate crisis, it's not going to affect anything else. Conversely, most foreign press sources are forecasting a nasty recession for the EU, at least a moderate and short recession for the U.S., and either a recession or a protracted period of extremely tepid growth for China. For years, China was stimulating its real estate market and nearly every other aspect of its economy. And both the effectiveness and feasibility of additional stimulus really appears to be nil going forward. Long accepted economic forces seem to be overwhelming their economic tactics at last. And they seem to be somewhat more willing to accept the inevitable now that they are going to have to go through some sort of economic cycle. They will have to slow or no growth in China for a period, it appears. So, meanwhile, the U.S. is selling the strength of the jobs market as one of the key reasons why a recession is not likely. And there's a number of videos that I have in mind to do, and one of them may be highlighting the net downward revisions to the headline numbers. But that is just one key headwind to the current economic construct. What about student loan payments resuming and siphoning up huge amounts of discretionary spending this fall? How about the fact that the hoard of savings that households accumulated during the pandemic era, usually by stimulus cash, that's expected to be exhausted by the end of the year? How about the increasing credit card debt and rising defaults? There are a lot of items adverse to everything chugging along as it has been as far as the business cycle. And, of course, GDI, again, gross domestic income, shows the economy is not nearly as productive as GDP seems to tell us. And so, I may do videos on one or more of these different things in the foreseeable future. However, let's refocus on the office market here. I want to find out what's going on. And, let's take a peek under the hood a bit. So if everybody's ready, buckle up, buttercups. But first, please like, subscribe, and ring the notification bell. Well, several good sources of data tell us the story. Let's go ahead and take a look at the second quarter 2023 report on the sector to get a baseline. Let's also look at some of the most challenged areas, find out what some of the dominant economic sectors that rely on office space foresee there needs to be, and review the debt picture. Because, ultimately, properties with debt are where the problems are going to come from. If a building were owned outright, they could be 50 to 60% or even more vacant and still cover all their expenses. But debt, declining values, increasing costs, whether it's for the debt or for some other expenses, these things are what will trigger market events. And just to put a final coat on the introduction of this video, let's describe what we want to see in the office property market from a real estate cycle perspective, because that is the fundamental driver for all overall trends. And if you didn't watch my last video, you may not realize the four-phase cyclical nature of real estate and the catalysts within them. Please check it out for a little more insight into the real estate cycle and the 5 property types referenced and tracked just from one particular source. So let me just give you the key nuggets that will help you with the rest of this video, so that as I quote things or reference things, you know what the focus is. So the long-term occupancy line, call it a catalyst or focal point of the cycle, because that really becomes a foundational fulcrum for supply and demand throughout the cycle. And other terms, of course, that are related to that as a catalyst are key. Terms like absorption are used. By the way, analysts often use the term net absorption to combine two things to communicate the difference between the increasing and decreasing occupancy levels or drivers. But absorption or net absorption, new construction, demolition, all these terms affect occupancy levels. And these terms and their relational relevance to long-term occupancy will matter as we progress and talk about this. So here's some important input, and the first source is the U.S. Office Outlook, second quarter 2023. It's also known as the U.S. Office Market Statistics, Trends, and Outlook, and that's from Jones Lang and LaSalle, which is JLL. Here's their opening synopsis. They say here, while office markets remain subdued by the lingering impact of remote work and a reversal of over a decade of historically low interest rates, signs have emerged that the U.S. office market is beginning to turn a corner and is tentatively on the cusp of a recovery. Tenants remain defensive and continue to downsize office portfolios through large volumes of sublease space being added to the market. But improved leasing momentum across most markets led to the first quarterly increase in gross leasing activity in 4 quarters. So, that initial intro, of course, it sounds good, but we want real data to back this up. They summarized what they found, and I'll comment on this as I go through it. But let me quote and comment on several of these factors now. So after 3 consecutive quarters of decline, they say, U.S. office leasing has begun to rebound in the second quarter, with gross leasing volume growing 11.6% quarter over quarter, the fastest growth rate since the second quarter of 2021, so 2 years. Here's my comment. It sounds phenomenal that they've had this 11.6% increase, but it seems like there can't be anything negative about the reversal they described, right? But an increase in gross leasing volume sounds great. However, an increase from what to what? And that's what you got to know. So net absorption remains negative. All right, that's not a very positive statement. So net absorption actually remains negative. So actually vacancy continues to grow, but is showing signs of crossing an inflection point. The U.S. lost an additional 12.5 million square feet of office occupancy in Q2, but the rate of decline slowed 40% from the over 20 million square feet of negative net absorption in Q1. So here's my comment. Okay, my take is that the previous paragraph was really just a positive spin on a market that has slowed its decline. The first 4 words of the statement were net absorption remains negative. So that's not a literal reversal at all, but a slowing of the decline. So it sounds like government budgeting math is being applied here a little bit. But anyway, continuing, they say this. A slowing volume of deliveries, increased leasing activity, and accelerated demolitions and conversions of older vintage product are pointing to the increasing likelihood that U.S. office vacancy rates will peak over the near term and begin to decline in 2024. And that sounds reasonable, and possibly it will prove to be true. However, it's a slow process, and it's a slow process in light of declining values, which make more and more property owners vulnerable to default. So, we're not out of the woods. It is just something that we are starting to show maybe the floor is starting to become visible here. So, again, quoting, it says here, asking rents nationally are continuing to grow, reaching $39.29 per square foot in the second quarter, which reflects 0.6% growth quarter over quarter. My comment here, that 0.6 growth is basically right about at inflation. And so, it's not really progressing. Rents are coming down, but that's asking rents. not contract rents or effective rents when concessions are factored in or anything like that. And they always try and keep that headline rental rate. If you've seen my office case study videos, you know what I'm talking about. They keep that asking rent nice and high, but then they give concessions on the backside. And so that's what we need to know if we're going to take their statement and run with it. So, again, reading their comment, just 1.4 million square feet of new office construction broke ground in the second quarter, signaling future supply constraints for tenants seeking high quality product. Um, Here's my comment. This is both good and bad. Of course, we need less space, but we also we have a lot of space. It doesn't mess with modern taste. We need uh, space that meshes with what people want. Tenants anymore, quality tenants especially, they need more than just some Spartan air conditioned box lit with fluorescent lighting. They have different expectations. So, moving back into just my own comments here. So, some pertinent data I culled from the report. Nearly 1 million employees nationally are facing return to office mandates in the second half of 2023, after 1.5 million in the first half already have. So, my suspicion is that a lot of these employees, or at least a noteworthy portion of these employees, may leave those positions because they won't want to sacrifice quality of life. They've tasted it, and they won't want to leave it behind completely. So even if 10 or 15% of employees changing jobs, this will hurt most firms. And many of those firms will have to adopt hybrid work models to retain that key talent. The train has left the station regarding remote work, and we will never get back to previous levels of office only workers culturally. They will tolerate working in the office if they don't have alternative options, but if they do, many won't accept. Returning to the office and enduring it, or they'll endure it for a while, and will take other opportunities when the time comes to maintain that quality of life. So here's a shocking stat that they can't really hide from. Here's the long-term annual leasing trend from prior to the pandemic. So this is what they rent on an annual basis nationally here. So this is what they say. Pre-pandemic average annual volume, which the report noted was 88.8 million square feet before the pandemic. The current pace is about 43 million annualized at 39 million annualized in the last quarter. So what they mean there is it's almost 50 million shy of the annual pace of leasing. So yeah, it's way off. And by the way, referencing that inflection point comment they made earlier, put it in context. Look at it like this: the office market is a skydiver that's been falling at terminal velocity. They've pulled the cord, and that initial drag chute popped out before the main canopy is pulled out and opens. That's what Q2 was, is that initial drag chute. Slowed us perceptibly from kind of a terminal velocity, but the real story is it's not good. But now we know it's a little bit better trend of bad. So, all right, last piece from this report: 34% of all leases expire between 2023 and 2025. That's not good, obviously. Many of those tenants will surrender space and downsize to fit realistic office staffing, because that's their needs going forward, less space. So, a third of the office market will sign leases for less space, but how much less? And what are the drivers? Also, in this environment, they may be signing with a lot larger concessions and for a longer term, believing that this may be something that will recover from in the next several years, and they'd end up paying more. So, in answer to all these questions, I do have some answers for sure. However, before I cover the challenged regions and sectors, and please, like, subscribe, and ring the notification bell, help us to continue to grow the channel. So anyway, locales. Well, here we go. Here's the most challenged today. We have 12 of the 25 largest markets that are above the national average in vacancy and have at least below inflation rent growth, if not declining outright. And here are those. Now we also have to remember we have new construction happening, or we have new construction that has just being completed. When the under construction space is added, those areas are all over 20% vacancy. through 2025. The long-term occupancy or long-term vacancy is around 12% nationally. So the long-term occupancy line is 88%. So, these areas, these are way outside that trend, and it will take years to bring that vacancy down. Now, only two of the remaining 13 markets, so 23 out of the 25, are all, above 12%, and only one of the two remaining have positive rent growth. So, in other words, 24 of the 25 largest markets are seeing critically unhealthy markets at this point. Um, so let's switch over to the real estate cycle and look at it from a cyclical standpoint. By the way, Q1, first quarter of 2023, that's the most recent cycle that's been published thus far. So point 7 through 10 on this are where they should have both above inflation rent growth and good occupancy numbers, which we wouldn't expect us to be in 7 through 10. By the way, the two reports, meaning the cycle tracking and the JLL report, Jones Lang LaSalle report I just quoted from, they somewhat contradict each other, which means somebody's data is off. But there is something unique in the cycle data that tells a unique story. So see how many points to the left of the center line show a -1 next to their city names? Consider that to mean those markets are sliding downhill backwards when they've been climbing it. So, and conversely, many cities to the right of the center line show a +1 next to the city. That means the cities that are also they're also sliding down the same hill, though they're moving forward down the hill. So this is pretty unprecedented for this tracking report, and it appears that they may be struggling to reconcile how to communicate what they are seeing. But anyway, moving on. What are some dominant economic sectors that rely on office space, and what do they foresee their needs to be going forward? Thinking about tech and medical office and this sort of thing. So, due to cutbacks in hybrid work, the tech sector will need offices for less workers. Okay, and that, according to what I found, it results in about a 20% projected reduction in lease space just for the tech sector alone. And that's per a CoStar article citing a CBRE source. But conversely, you have like medical office. It seems largely unaffected. Clearly that kind of makes sense because of the nature of that field. You can't work from home if you're seeing patients, but medical office, they're still holding their occupancy quite well. So lastly, let's talk about some debt issues, that are caused by, falling values and higher interest rates, et cetera. I shared a lot of information on debt in last week's video, so I won't cover that much today. But here's a new statement on commercial mortgage-backed securities specifically, and the delinquency rates associated with them. And it's from a different source from last week. But again, before I quote that, please like, subscribe, and ring the notification bell if you would. Thank you again. So here's the quote. Commercial mortgage-backed security loans on these buildings have seen delinquency rates almost triple so far in 2023, now at 4.5%. I expect that, meaning that rate, to hit double digits in the not too far off future. Some $500 billion in loans on these facilities, meaning commercial mortgage-backed securities, on these facilities are coming due over the next 3 years. Rates to refinance this debt have soared since the Fed began their monetary tightening in early 2022, even as values for these properties have plunged. Many owners will simply hand in the keys rather than roll over loans on assets they no longer have positive equity in. This will force down values further. So that's the loop. That's a concern, and that's what this individual is forecasting. So, okay, debts, $500 billion. Delinquencies up 3 times this year alone, and nearly tripling again in the foreseeable future. Clearly not positive. But here's another quote that further states foreseen issues with banks caused by the synergy of both commercial mortgage-backed securities and the bank-held loans, outright loans on real estate, that will be impacted soon by all these factors. So here's a statement on banks. The beleaguered regional banking system has some 70% of these loans, which make up a substantial portion of its overall loan portfolio. At the very least, rising defaults will lead to more write offs and tightening credit conditions for many sectors of the economy, such as small business. Obviously, small business drives a lot of hiring, so I want to make note of that. In a more dire scenario, we will see more regional bank failures along the lines of Silicon Valley Bank. The market managed to ignore the accelerating pain in the real estate markets in the first half of the year. Will it continue to do so in the back half of 2023? This gentleman says, my bet is that it won't, and at some point during the year, second half of this year, this realization will cause a significant hiccup in equities. Wow. And the reason I say wow, he expects it to finally become unavoidably problematic in the second half of 2023, and then it'll be reflected in the stock market. When the stock market moves, then it becomes real news because that's what CNBC and these different business channels happen to cater to. So, hopefully it doesn't become a doom loop news cycle issue. The public really needs facts, not emotionally driven rhetorical sensationalism, which is often what we got in 2008 during the financial crisis. But here's an observation. I've got several here I want to make. You can only be an ostrich for so long before you have to deal with the reality around you, and that's what's been happening. By the Fed, the media, the federal government. This issue is ripening, and at least some of us are paying attention to what is happening, trying to provide some genuine insight. But they've not clearly been ignoring this issue, maybe to their own peril, and ultimately taking us all with them. But here's a parting observation on a recent economic focused opinion piece by a gentleman by the name of Tom Rogers. And this was originally published in Newsweek. I read it on MSNBC, though. And while I don't know this gentleman or follow him, I read through what I consider to be a bit of a dumpster fire, and I made a couple observations. First, the title. Biden saved the economy and launched a new age of prosperity. Why isn't he getting any credit? And this is an opinion piece, Well, other than being a shockingly biased and truly laughable premise right within the title, and the fact that Paul Krugman being quoted would be considered anything nonpartisan is also pretty laughable at this point. Though, to be fair, he did a fabulous economics textbook earlier in his career, but he took the wrong pill at some point and abandoned a lot of the solid economic theory he'd espoused back then, went into this partisan thing that he's been doing for the last decade or two. But anyway, that's not news. So the thing that actually shocked me with this article wasn't what was written. You're going to find a lot of that. It was the likes and dislikes associated with the repost on MSNBC and how lopsided they were. Now, MSNBC is not considered a right-leaning site by any stretch. It is generally accepted to be left-leaning, maybe not radically left-leaning, but left-leaning. So the expectations that, you'd have more left-leaning readers than right, that's a pretty reasonable assumption. And also that the support levels from the readers would fall on partisan lines, especially for MSNBC bubble, their bubble readers. But here's a few stats for you. Approximately 29% of voters are registered Democrats in the country, 27% are Republican, and 42% independent. Okay, so you would expect the support of the Democrats reading the piece and hitting the thumbs up to be down. So you'd figure 29% anyway. Well, the ratio of 463 likes to 9,000 plus dislikes, I'd say that 95% or so that dislike this piece shows that most of the Democrats disagreed with the assertions within the piece as well. The success of Bidenomics as a narrative may be worse than the policies themselves. I've been highlighting some of the challenges with the numbers here. GDI versus GDP referenced just in the last couple of weeks alone shows that the booming economy is an illusion. Strong GDP is not because of the consumption, investment, or net exports that are input into the GDP formula and genuinely drove it. It's because government spent $6.7 trillion last fiscal year and elevated GDP accordingly with that. a trade recession, the 9-month-long manufacturing recession that is ongoing, collapsing international demand for goods. All these aren't good for the U.S. economy. And much of the data shows a damaged economy that is softening, actually softening somewhat quickly in some ways, and not robustly growing. And that is why the Conference Board recently forecast a recession in the near term. Well, the narrative the general narrative has been all about no recession and booming economy because the Conference Board is independent and they care about their reputation. They tell it like it is. So, but I'll put a caveat here. It doesn't mean that Biden should take all the blame for some of the things that have been challenging the economy. Post-pandemic, there are a lot of disruptions to work through, and that happened when Biden was still in his basement in Delaware. So it isn't his administration or his policies at work. Conversely, he hasn't done much anything genuinely right. Here's one example: gas higher than 4 years ago. That's not shocking. It's actually kind of expected. But the $4 or so a gallon that we're seeing nationally now is higher than it would be if regulation didn't empower other entities like OPEC Plus to assert greater influence on pricing than they would have had otherwise. The oil production argument, and this is definitely a personal opinion, the oil production argument used is the need to curtail fossil fuels and to help the climate, which is admirable and I agree with. But curtailing U.S. production is the worst thing we could do for the planet. We should want to have the strongest possible environmental regulation and oversight on the production of oil, and curtailing the domestic production simply shifts that oil production to countries who allow more pervasive environmental damage than we would here. So, buffoonery is being exported, and the planet and the economy is both suffering because of it. So, but just to get back to GDP, what the government has done is spend to keep gross domestic product high. Hiring people to support employment numbers. Has been a lot of state, local, and some national hiring by government which has boosted the employment rolls. And, they put out sweet headline numbers that are typically being softened in later revisions. So most people see the economy softened, especially in 2022. The lack of genuine improvement in the last year is also obvious. And, I know I would have seen it without a master of finance from Harvard and a few decades of observing and analyzing economic and market data. Okay. It's not hard to see. So the story I referenced, it's pretty pitiful. It's truly woefully pathetic as a sales job. That is, and it's kind of become the norm in politics in recent decades. But I will be doing a multifamily sector video focused really on what we are seeing arise within the multifamily market. Because the market is now suffering strains due to debt, interest rate related value shifts, just like everything else. And some of these issues are, they're starting to coalesce enough to make it noteworthy. But anyway. Thanks again for joining us for another video on this topic. Remember, Forecast Radio will be up at the end of the week. And so until next time, ciao. Tosha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.